Today we will talk about basic financial products used by investors by and large. There are two basic products, debt and equity. Today we will talk about debt in detail. Debt is a loan and debt market is the market where debt instruments are traded. Debt instruments are assets that require a fixed payment to the holder, usually with interest. Examples of debt instruments include bonds, government or corporate, and mortgages. The principal role of debt markets is to transfer capital from savers to borrowers, investors, and allocate them in an efficient manner among competing uses in the economy, thereby contributing to growth both through increased investment and through enhanced efficiency in resource use. The best advantage of the debt market is that it guarantees returns. The risk associated with it is less, making it a popular choice of investors. The debt market instruments can be a good source of fixed income. The liquidity of the debt market is comparatively high. Debt instruments are assets that require a fixed payment to the holder, usually with interest. Examples of debt instruments include bonds, government or corporate, and mortgages. There are different types of debt instruments available in India. Bonds. Bonds are issued by governments or businesses. Investors pay the issuer the market value of the bond in exchange for guaranteed loan repayment and the promise of scheduled coupon payments. This is the annual rate of interest that a bond pays. It is generally expressed as a percentage of the bond's face value. Certificates of deposit. A certificate of deposit (CD) is a product offered by banks and credit unions that provides an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. Almost all consumer financial institutions offer CDs, although it's up to each bank which terms it wants to offer. How much higher the rate will be compared to the bank's savings and money market products, and what penalties it applies for early withdrawal. Commercial papers. Commercial paper is a commonly used type of unsecured, short-term debt instrument issued by corporations, typically used for the financing of payroll, accounts payable and inventories, and meeting other short-term liabilities. Maturities on commercial paper typically last several days, and rarely range longer than 270 days. Commercial paper is usually issued at a discount from face value and reflects prevailing market interest rates. Debentures. A debenture is a type of bond or other debt instrument that is unsecured by collateral. Since debentures have no collateral backing, they must rely on the creditworthiness and reputation of the issuer for support. Both corporations and governments frequently issue debentures to raise capital or funds. Fixed deposit (FD). When you put your money to work in fixed deposits, you basically lock the amount for a fixed period of time. You can earn interest on the principal sum throughout the tenure on a cumulative basis. The interest earned gets added to the principal amount after every specific interval. Sex government securities. In the investing world, government security applies to a range of investment products offered by a governmental body. For most readers, the most common types of government securities are treasury in the form of treasury bond, bills and notes. However, the governments of many nations will issue these debt instruments to fund necessary ongoing operations. National Savings Certificate (NSC). The National Savings Certificate (NSC) is a fixed income investment scheme that you can open with any post office branch. The scheme is a Government of India initiative. It is a savings bond that encourages subscribers, mainly small to mid-income investors, to invest while saving on income tax. In next video we will talk about equity.